The stock market can be a scary place, especially for beginners. It's important to be careful. Many traps can snare your hard-earned money. Don't let scammers win. Learn how to spot them and keep your investments safe. Think of it like this. You wouldn't leave your front door unlocked, right? Protecting your investments is just as important. It's all about being smart and staying vigilant. Your financial future depends on it. Remember, knowledge is power. The more you know about stock market scams, the better equipped you'll be to avoid them. So let's dive in and learn how to protect ourselves. Let's talk about some common stock market scams. These traps can catch even the most experienced investors off guard, leading to significant financial losses. Understanding these scams is crucial for anyone looking to invest in the stock market. One of the most notorious scams is called the pump and dump. Here's how it works in detail. Scammers artificially inflate a stock's price by spreading misleading or false information. This creates a buzz around the stock, causing its price to spike rapidly. They spread false positive news through various channels, including social media, online forums, and even fake press releases. This is the pump phase, where the stock appears to be a lucrative investment. Unsuspecting investors, seeing the price rising and fearing they might miss out on a great opportunity, start buying the stock in large quantities. This further drives up the price. Once the stock price reaches a certain high, the scammers sell their shares at the inflated price, making a substantial profit. This is the dump phase. After the scammers sell off their shares, the stock price crashes, leaving the unsuspecting investors with significant losses. The stock often plummets to a value lower than its original price. Another common scam is insider trading. This practice is illegal and unethical. Insider trading involves buying or selling stocks based on non-public, confidential information that can affect the stock's price. Imagine an executive at a company knows about an upcoming product failure or a major corporate crisis that hasn't been announced to the public yet. They might sell their shares before the news goes public to avoid losses or even to profit from the information. This is a clear case of insider trading and is punishable by law. Remember, if something seems too good to be true, it probably is. Scammers often lure investors with promises of guaranteed returns or insider tips. Be wary of anyone offering guaranteed returns or hot stock tips. These are often red flags indicating a potential scam. Always do your research and invest wisely. Take the time to understand the market, verify information from multiple sources, and be cautious of investments that promise quick and easy profits. By staying informed and vigilant, you can protect yourself from common stock market traps and make more informed investment decisions. Let's talk about red flags. These are crucial indicators that something might be amiss in the world of finance and investments. These are warning signs of a potential scam. Recognizing them early can save you from significant financial loss and stress. One big one is unsolicited stock tips. These often come out of nowhere, promising huge returns with little to no risk. If someone you don't know emails or calls you with a hot stock tip, watch out. These tips are usually too good to be true and are often part of a larger scam. Another red flag is high-pressure sales tactics. Scammers will try to create a sense of urgency to make you act without thinking. If someone pressures you to invest quickly, don't give in. Take a step back and evaluate the situation carefully. Take your time, do your research, and make a decision based on facts, not pressure. A well-informed decision is always better than a rushed one. Be wary of overly positive news or guaranteed returns. No investment is without risk, and anyone who tells you otherwise is not being honest. Remember, investing always involves risk. Market conditions can change rapidly, and what seems like a sure thing today might not be tomorrow. Anyone who tells you otherwise is likely trying to scam you. Trust your gut. If something feels too good to be true, it probably is. If something feels off, it probably is. Your intuition is a powerful tool in identifying potential scams. Don't be afraid to walk away from a deal that seems too good to be true. It's better to miss out on a potential opportunity than to fall victim to a scam. Consult with a trusted financial advisor before making any major investment decisions. They can provide valuable insights and help you avoid potential pitfalls. Always read the fine print and understand the terms and conditions of any investment. Knowledge is your best defense against scams. By staying informed and vigilant, you can protect yourself from scams and make sound investment choices. Stay smart, stay safe, and don't be fooled. Due diligence is key to avoiding scams. This means thoroughly researching before investing. Look at the company's financials. Are they making money? Do they have a solid track record? Check out the management team. Are they experienced? Do they have a good reputation? Read independent analyst reports. Get different perspectives on the company's prospects. Don't just rely on what the company says about itself. Look for unbiased sources of information. Remember, knowledge is power. The more you know about a company, the better equipped you'll be to make sound investment decisions. Section 5. Technical analysis. Spotting the tricks. Technical analysis can also help spot potential scams. Look for unusual trading patterns. For example, a sudden surge in volume or price without any news could be a red flag. Examine the stock's chart history. Are there any suspicious price movements? Compare the stock's performance to the overall market. Is it significantly outperforming or underperforming for no apparent reason? Remember, technical analysis should complement, not replace, fundamental analysis. Use both to get a complete picture of a stock's potential. Section 6. Nifty 50 Real-World Scam Alerts. In this section, we delve into the world of financial scams that can affect even the most reputable indices. Even well-known indices like the Nifty 50 aren't immune to scams. These indices, which are often seen as benchmarks of market performance, can sometimes become targets for fraudulent activities. Always be on the lookout for suspicious activity, even in established markets. Scammers are becoming increasingly sophisticated, using advanced techniques to deceive investors. For example, in 2021, the Securities and Exchange Board of India, or SEBI, issued a warning about fraudulent schemes targeting Nifty 50 investors. These warnings are crucial as they help protect investors from falling prey to scams. These schemes promised unrealistic returns and lured investors with fake websites and marketing materials. The promises of high returns with little to no risk are often a red flag. Always verify information from official sources. Cross-checking details with reliable and official platforms can save you from potential financial losses. Check the SEBI website or contact your financial advisor if you encounter any suspicious investment offers related to the Nifty 50 or other indices. Financial advisors can provide valuable insights and help you navigate through dubious offers. Remember, scammers are constantly evolving their tactics. They adapt to new regulations and market conditions, making it essential for investors to stay vigilant. Stay informed and be cautious of any investment opportunity that seems too good to be true. Educate yourself about common scam tactics and always approach investment opportunities with a healthy dose of skepticism. Attending seminars and workshops on financial literacy can also be beneficial. These events often provide valuable information on how to identify and avoid scams. Additionally, reading books and taking online courses on investment strategies and financial security can further arm you with the knowledge needed to protect your investments. By staying informed and cautious, you can safeguard your investments from the ever-present threat of financial scams. Always remember, if something seems too good to be true, it probably is. Section 7. Stay safe. Practical tips and tricks. Here are some practical tips to avoid stock market scams. Be wary of unsolicited investment advice. Don't trust anyone who guarantees high returns with low risk. Never send money to someone you don't know or haven't thoroughly vetted. Don't invest in something you don't understand. Use strong passwords for your online brokerage accounts and enable two-factor authentication. Remember, if it sounds too good to be true, it probably is. Be skeptical, ask questions, and do your research before investing your hard-earned money. Section 8. Report scams. Protect yourself and others. If you think you've encountered a stock market scam, report it. Contact the Securities and Exchange Board of India, SEBI. You can also file a complaint with the police's cybercrime cell. By reporting scams, you're not only protecting yourself, but also helping to protect others. Your actions can prevent someone else from falling victim to these fraudulent schemes. Remember, we all have a role to play in fighting financial fraud. By staying informed, being vigilant, and reporting scams, we can create a safer investment environment for everyone.